You know what's fascinating about Wall Street? They tell you one story on television while writing a completely different story in their private vaults. And right now, that disconnect has never been wider. It's not just wide, it's a chasm. And if you're not paying attention, you're about to fall right into it. Morgan Stanley just released their 2026 S&P 500 target. Bullish. Very bullish. CNBC can't stop talking about it. Bloomberg's got it on repeat. Every financial talking head from New York to London is parroting the same line. Stocks are going higher. Stay invested. Don't miss out. The bull market is alive and well. And you know what? Maybe they're right. Maybe the S&P does hit their target. Maybe we see another incredible year of gains. Maybe your portfolio does exactly what they're predicting. But here's what they're not telling you on television. Here's what doesn't make it into the CNBC soundbites or the Bloomberg headlines or the Wall Street Journal op-eds. While Morgan Stanley's equity team is doing the media circuit, pumping up stock targets, shaking hands, doing interviews, telling everyone how bullish they are on equities, their commodity desk is doing something completely different, something they're not broadcasting, something that doesn't fit the narrative they're selling to retail investors. They're buying silver, physical silver, not paper contracts, not ETFs, not shares in mining companies, actual metal, bars, coins, physical assets that you can hold in your hand, and they're buying it for their wealthiest clients. The ultra-high net worth individuals, the family offices, the people who don't get their financial advice from cable news, the people who have direct access to Morgan Stanley's private wealth management division, those clients, the ones who actually move markets, and they're not buying small amounts, they're accumulating silver in quantities we haven't seen since before 2008, before the financial crisis, before the last time Wall Street's public message and private actions were this catastrophically disconnected. Now, why would that be? Why would the same institution telling retail investors on CNBC to load up on stocks be quietly accumulating precious metals for their high net worth clients? Why the disconnect? Why the two completely different strategies for two completely different audiences? Listen to what they say, watch what they do. The two haven't been this disconnected since 2007, and we all remember what happened after 2007, don't we? So let's do some terrifying math together, real math, the kind they don't show you on the investing shows because it ruins the narrative they're trying to sell. Say you take Morgan Stanley's advice, you go all in on stocks, you're bullish, you're optimistic, you believe the target, and let's say they're right, let's give them the benefit of the doubt. Say you make 20% in 2026, that's a great year, you beat most investors, you beat the historical average. Congratulations, you did exactly what Wall Street told you to do, and it worked out. You're up 20%. Your portfolio looks beautiful, the numbers are green. You feel like a genius. But while you were making 20% in stocks, something else was happening in the markets, something that doesn't show up in your brokerage statement, something that doesn't trigger a congratulatory email from your financial advisor. Silver was moving. And it was moving differently than stocks. In the past 24 months, the silver to S&P ratio has shifted dramatically. What your stock gains can actually buy in terms of real physical assets has been quietly eroding. Not loudly, not obviously, but consistently, relentlessly. Here's the brutal reality that nobody wants to talk about. If silver continues on its current trajectory, and considering the supply-demand fundamentals that we're going to get into, your 2026 stock gains might buy you 50% less silver than they would today. Let that sink in for a moment. You made 20% in nominal terms. Your account balance went up. You can show your friends. You can feel good about your investment decisions. But in real purchasing power, in tangible assets, in things that actually hold value when the system gets stressed, you went backward. You made money in dollars, but lost wealth in real terms. This is the game they don't explain on television. This is the wealth transfer that happens in silence while everyone's watching the ticker tape. You thought you were winning because your portfolio went up. But the finish line moved, the goalposts shifted, and the people who moved them, they're the same ones who told you which direction to run. This isn't conspiracy. This isn't some wild theory cooked up in a basement somewhere. This is portfolio construction at the highest levels. This is how institutional wealth actually works when you get past the marketing and the public relations and the television appearances. The ultra-wealthy aren't choosing between stocks and metals. That's not how they think. That's not how wealth preservation works at that level. They're doing both. They're long equities and they're accumulating hard assets, but they're doing it quietly, without fanfare, without press releases, because here's what the wealthy understand that most investors don't. When everyone is bullish on the same thing, that's not an opportunity, that's a risk. That's a crowd. That's a trade that's already priced in. The real opportunity, the real wealth preservation happens in the assets that aren't being talked about, in the things CNBC isn't breathlessly covering. In the positions that don't generate clicks or views or engagement, they diversify into what others aren't watching, into what the mainstream financial media isn't talking about every single hour of every single day, into physical assets that can't be printed by a central bank, can't be diluted by a government, can't be conjured out of thin air by monetary policy, assets that have held value for thousands of years, assets that survive regime changes and currency collapses and financial crises. Morgan Stanley's commodity desk knows this. That's not speculation. That's not rumor. That's observable behavior if you know where to look. That's why they're accumulating silver for their wealthiest clients while their equity strategists are on television telling everyone else to buy stocks. The question is, do you see it? Are you paying attention to what they're doing or just what they're saying? We've seen this movie before. The plot is familiar even if the actors have changed. 2007. Remember? Wall Street was unanimously bullish on housing. Real estate couldn't go down. Everyone said so. The experts agreed. The models proved it. Subprime mortgages were safe. Mortgage-backed securities were AAA rated. And stocks? Also going up forever. The bull market was unstoppable. The fundamentals were strong. Everything was fine. Meanwhile, a few people, the ones actually looking at the data instead of repeating the consensus, were quietly positioning for something very different. They were buying insurance. They were shorting mortgages. They were accumulating gold. They were preparing for a scenario that everyone else said was impossible. The media called them crazy. Pessimists, perma-bears, doom and gloomers, people who didn't understand the new paradigm until they weren't, until the consensus was wrong, until the impossible happened, and those crazy pessimists, they preserved and multiplied their wealth while everyone else got wiped out. Today we're watching an eerily similar pattern. Wall Street is unanimously bullish on stocks. The S&P looks unstoppable. The Nasdaq is on fire. Technology is the future. AI is changing everything. The bull case writes itself. Everyone agrees. The consensus has never been stronger. But in the shadows, away from the cameras and the headlines and the retail hype, the smart money is moving into hard assets. Silver, gold, physical commodities, not instead of stocks, in addition to them. As insurance, as diversification, as real wealth preservation. Because they know something that doesn't make it onto the evening news. They understand something about the nature of money and value that doesn't fit into a 3-minute CNBC segment. They're looking at fundamentals that Wall Street doesn't want retail investors focused on because it complicates the narrative. It makes people ask uncomfortable questions. It makes people wonder if maybe, just maybe, the emperor has no clothes. Let's talk about silver fundamentals for a moment. Real fundamentals, supply and demand. The basics of economics that still matter even in our modern financial system. Silver has industrial demand unlike anything in history. This isn't your grandfather's precious metals market. This isn't just jewelry and coins and investment bars. Silver is now critical infrastructure for the modern economy. Solar panels need silver, every single panel. There's no substitute that works as well. As the world transitions to renewable energy, as governments mandate solar installations, as ESG investing pushes companies toward green energy, the demand for silver goes up. Not might go up, not could go up, does go up mathematically. Inevitably, electric vehicles need silver, much more silver than traditional cars. The average EV uses 2 to 3 times more silver than a combustion engine vehicle. As EV adoption accelerates, as more countries ban gas-powered cars, as Tesla and Rivian and Ford and every other manufacturer ramps up production, the demand for silver increases. Every single vehicle that rolls off the line needs silver. Lots of it. 5G infrastructure needs silver. The build-out happening right now, globally, requires massive amounts of silver for the electronics and conductors and connections that make the network function. As we move towards 6G, as the Internet of Things expands, as smart cities become reality, the industrial demand for silver compounds. Military applications need silver. Electronics, weapons systems, communications. In an increasingly tense geopolitical environment, military spending is rising. That means more demand for silver. Defense contractors are buying, governments are stockpiling, and they're not price sensitive the way retail investors are. The demand side is exploding, undeniable, measurable, provable. But what about supply? Global silver supply is declining, not growing, declining. Mines aren't keeping up. New discoveries aren't replacing depleted reserves. The easy silver has been mined. What's left requires more energy, more money, more infrastructure to extract. Mining companies are struggling with costs. Many marginal mines have closed. The supply is constrained and getting more constrained every year. Recycling can't fill the gap. Silver gets used in industrial applications where it's not economically recoverable. It's in tiny amounts in millions of products. You can't recycle the silver out of a solar panel the way you can melt down jewelry. It's gone, consumed, lost to the economy. This is different from gold, where almost every ounce ever mined still exists in some form. So we have surging demand meeting declining supply. This is economics 101. Price should be going up, way up, but it's not moving the way the fundamentals suggest it should. Why? Because the paper market for silver, the futures, and derivatives and ETFs vastly exceeds the physical market. Banks can suppress price through paper contracts, for now. But physical silver is different. Physical silver actually has to exist, has to be delivered, can't be created with a keystroke, and that's what Morgan Stanley's commodity desk understands. That's why they're buying physical, not paper, because when the paper market breaks, when the disconnect between paper price and physical reality becomes too extreme, physical silver holders are going to be on the right side of the most violent repricing in commodity history. But there's more. Central banks are accumulating precious metals at rates not seen in decades. Poland, Hungary, China, Russia, India, Turkey. Central banks around the world are buying gold and silver, not selling, buying. They're diversifying away from dollars, away from treasuries, into hard assets. Why? What do they see? What do they know that they're not announcing in press releases? They see the same thing Morgan Stanley's private wealth clients see. They see a global financial system built on unprecedented amounts of debt, government debt, corporate debt, consumer debt, debt that can never be repaid in real terms.
Investors are rallying behind tech
Debt that will
giants.
either
The
be
market
defaulted
is
on
soaring to
or
new
inflated
heights
away.
globally.
And when that happens, when the reckoning comes, the assets that will hold value are the ones that can't be printed. The ones with thousands of years of history as stores of value. The ones that have survived every currency collapse and sovereign default and financial crisis in human history. But sure, let's talk about the S&P 500 target for 2026. That's the story they want you focused on. That's the narrative that keeps you in the system, that keeps you buying stocks while they accumulate the real assets. This is the game, and it's been played for centuries. Public message. Stocks are going to the moon. Don't be left behind. FOMO, get in now. The train is leaving the station. Private action. Accumulate hard assets, quietly, consistently, without announcement. While everyone else is chasing the NASDAQ and the S&P and whatever momentum trade is working this quarter. This isn't cynicism. This is how wealth preservation works. This is how the intelligent money operates when it's not trying to sell you something. The wealthy don't just chase returns. That's for retail investors. That's for people who learned about investing from TikTok. The wealthy protect purchasing power. They understand that making 20% in a currency that's losing value, in a system that's becoming more fragile, in an economy held together by central bank interventions isn't the same as building real wealth. Your portfolio might say you're up. The numbers might be green. Your financial advisor might congratulate you. But what can that portfolio actually buy? Not in dollars, in real things, in assets, in purchasing power. That's the question Morgan Stanley's private wealth clients are asking. That's the metric they're measuring. Are you, or are you just watching the ticker and feeling good when the numbers go up? Here's your choice for 2026. Option A, do what they say. Do what Wall Street tells retail investors to do. Go all in on stocks, believe the targets, trust the narrative, hope the bull market continues, hope nothing breaks, hope the system holds together for another year. And watch your nominal gains potentially lose purchasing power against real assets while the people who gave you that advice stack physical silver in vaults you'll never see. Option B, do what they do, not what they say. What they actually do with their own money and the money of their wealthiest clients. Yes, stay invested in growth, stay long equities, participate in the bull market if it happens. But also accumulate the assets they're not talking about on television. The ones being quietly loaded into private vaults while CNBC talks about the latest tech stock. The ones that don't generate commissions for brokers or clicks for financial media, but actually preserve wealth when the system gets stressed. The math is simple, terrifying in its implications. But simple. If silver outpaces your stock gains in real terms, which the current trajectory and the fundamentals and the supply-demand imbalance all suggest is likely, then your winning year in the market actually leaves you with less wealth in tangible terms. You won the game they showed you. The scoreboard said you won. But you lost the game they were actually playing. The game where winning means preserving purchasing power and accumulating real assets, not accumulating dollars in a brokerage account. Morgan Stanley is bullish on stocks for 2026. Fine, I'm not saying they're wrong. Maybe they're right. Maybe the S&P does hit their target. Like they're preparing for something. Like the public narrative and the private reality are two completely different things. So which message do you listen to? The public one designed for mass consumption and retail investor psychology, or the private one revealed through the actual behavior of the smart money? Listen to what they say. Watch what they do. The disconnect tells you everything you need to know. It always has. It's just a question of whether you're paying attention.